to the Wall Street Geek, where I try to be once, twice, 3 times a geeky, and to help you become better informed about important money matters. But first, here's a story. Now, this past summer, I served on a jury here in New York City. The trial and the defendant were not only a reminder that nothing good happens when you're out past 3 a.m., but the trial was also a great lesson in subtle parts of the law. One area was drawing inferences in how you can come to a reasonable conclusion if the evidence that you base your conclusion on are solid facts. For example, if you go outside and see water on the ground, that's actually not enough to say that it rained. However, if you see people with umbrellas and if you hear thunder, you can reasonably infer that it rained. You could say that the rain, umbrellas, and thunder are indicators pointing to the fact that it rained. And speaking of indicators, that leads us to today's topic. Today's topic is about economic indicators. Now, we all know about them. News anchors really emphasize their importance every single month. But how does an investor use these indicators? Well, let's take a closer look. The financial markets are places where companies sell stock to the public to raise operating capital. It's the public's or investors' role to offer a price for a company's stock that's reflective of what the investor feels that stock is worth. That decision of worth may be based upon which way the investor feels the price may move in the future after the investor makes a decision to either take ownership of shares by buying or to bet against the company by selling. Now, there are other ways to participate in the market besides buying and selling stocks, which we'll cover in future videos, so you better come back. Economic indicators are a tool in an investor's belt to help analyze how a particular stock's industry may do in the future, and even how the overall market may trend in the future. More specifically, it's the leading indicators that investors use, not so much the lagging and coincident indicators. Now let's look a little more closely. Leading indicators hint at future business activities. So if business inventories are up and if new construction is up, it tells investors that businesses are prepping for an increase in consumer demand for products, real estate, and other goods. Key leading indicators include business sales and inventories, manufacturer shipments, inventories, and orders, and new construction. These 3 in particular can be found on the U.S. Census Bureau's site, and that's www.census.gov, and these are all leading indicators. On the flip side, you probably hear quite a bit in the news about indicators like the unemployment rate or the jobs number, which is announced on the first Friday of every month at 8:30 a.m. Eastern. Well, surprise, it's actually a lagging indicator, a type of indicator that could still be getting worse or better up to a half year after the economy already started to change, like improve for the better or get worse. So while the jobs number is a good measurement of how strong the labor market is, a jobs number today reflects the economy as it was up to 6 months ago. This and other lagging indicators are valuable tools to measure which way an economy is trending over time. However, lagging indicators are not so useful as an investor when it's your goal to act on a mispriced investment opportunity before another investor catches on and bids up the price. Coincident indicators can also be useful to investors, and these are ones that reflect the current state of an economy. A good example is the GDP. That measures today's level of productivity. Coincident indicators are particularly watched in what I consider more sensitive and shorter-term markets like currency trading or foreign exchange, also known as Forex. A coincident indicator like a country's GDP, when announced, may cause an investor in a market like Forex to change his or her strategy instantly. And when announced, it can cause a dramatic rise or dramatic fall in correlated investments. So what does all this mean to you as an investor? Well, let's take a look at a top leading indicator, and that's the durable goods orders number. It's a leading indicator for future manufacturing activity, and it's released monthly by the Census Bureau. Now, why is an increase in durable goods orders for factory goods a good thing? Well, if factories increase their orders for parts and other things to assemble computers, machinery, etc., this means that in upcoming months, workers will have jobs and manufacturers will be producing goods to sell. Now, if this number is trending up, manufacturers may be anticipating future demand. Otherwise, it wouldn't be increasing their orders for parts. Unfortunately, the opposite can be inferred as well. So if this number is decreasing, the manufacturers may not be expecting demand for their goods, which may hint at fewer jobs in the future for folks in that sector and less productivity from the manufacturing sector as a whole. The last report came out September 21st, and that was the report on durable goods orders as of August. August durable goods orders were down, although this year the number has actually been more up than down. Nevertheless, looking at this chart, an investor may say that demand for goods is expected to be weak in the future. I think because consumers are in debt, and if they have more income coming in, it's used to actually pay off debt or to save. And looking at this tells me that the economy is still recovering and still trying to gain a foothold. The next report on durable goods orders is coming out October 27th, and it usually comes out on or around that same time each and every month. So I'm guessing you may be watching out for it like me. So that's it. We discussed how the future of an economy may be inferred based on leading indicators. We analyzed a top leading indicator, the durable goods orders report. We also discussed the difference between leading, lagging, and coincident indicators. We're often bombarded with numbers like the jobs number each and every month without really knowing if that number is telling us where we are, where we're headed, or where we were as an economy. By knowing the difference between leading indicators and the others, you may become better positioned as an investor, and even as a consumer, and also as a saver. Thanks again for watching. This is the Wall Street Geek, hoping that you live long and profit. I hope to see you next time. Okay? Bye.